Welcome to the Deep Dive. This is where we take that stack of sources you've shared and, well, we unpack them just for you. This week, we're diving into a really fascinating mix, lots of market commentary. We're looking at, everything from the big index moves, some specific stocks, right through to some pretty interesting stuff on crypto-adjacent companies and, the usual macro events shaping things.
That's right. And the sources you sent over, they give us a pretty good picture of last week's action. And they definitely set the stage for what's coming up. We'll be digging into volatility, the bond market, commodities, think oil, metals, and even some key earnings reports that are on the radar.
Yeah, and tucked away in there, we even got a little peek at some, personal weekend stuff, travel, that kind of fed into the market view from the sources. So our mission here, as always, is to cut through all that noise. We want to pull out the really important bits, the key insights, and figure out what's genuinely essential in these sources for you to understand the market right now and maybe, shape your own trading ideas.
Okay, let's do it.
All right, so let's look back. Last week, what was the general vibe in the market according to these sources? I know one thing that popped was the S&P hitting 6,000.
Yes, that big round number. It definitely got mentioned. S&P crossed 6,000. But the perspective offered is, kind of interesting. While it's big and round, the sources suggest it might not actually mean a single thing.
Right.
Because, the index itself, it doesn't even know what 6,000 is. Individual stocks certainly don't.
Yeah. That classic market realism, isn't it? These numbers are just, things we notice. Still, as they said, interesting for those watching. How about bonds and commodities?
Bonds were pretty active. They started off selling off partly on some Fed numbers,
Right.
But then they saw a pretty strong rally later in the week. So, end result, bonds finished lower overall, stocks finished higher, commodities were just described as A.
Okay, what does A translate to? Just kind of flat, sideways?
Pretty much, yeah. Not a lot of strong direction, no big moves last week in that space, at least according to these sources. Just treading water, really.
Got it. Okay, shifting gears a bit from the numbers. One source pointed to something else as the most interesting story of the week. What was that?
Yes. That was what they call the Trump-Elon breakup. Or, the bromance is over.
Okay, yeah, saw those headlines. But here's where the sources get really interesting, right? Their analysis of how this actually impacts the market. It's maybe not what you'd expect.
Not at all. They strongly argue that the market hitting 6,000 is not the market saying hooray for these guys. Instead, the thinking is the market has actually discounted both of them.
Discounted them? Wow. Why? Why do the sources think the market's doing that?
Well, the rationale is, the market looks forward. Always. It's thinking 2 years out, 4 years out. It doesn't really get bogged down in the past headlines or, the personal dramas. The view expressed is it's actually maybe healthier. Healthier when everybody is not in cahoots and there's a little conflict. It lets the market kind of normalize and look past the immediate noise.
So what's the takeaway for you listening? It suggests that these big market moves, even hitting numbers like 6,000, they're driven by future expectations, way beyond the immediate headlines or what big personalities are doing. The market, in this view, is already looking past all this current stuff.
Exactly. It's always pricing what's next, not what just happened yesterday.
Okay, let's pivot them from that big picture to some specifics mentioned for the week ahead. Risks, opportunities, especially around earnings. GameStop, Oracle, Adobe. GameStop's first up Tuesday, the question posed, is GameStop relevant again?
The sources have an incredibly strong take on this, and it's negative. The answer is a very clear no. The CEO gets described in, exceptionally harsh terms. Words like utterly incompetent, disgrace, just chasing any shiny object.
Wow, okay, not holding back. So if the view's that bad, why is the stock, why is it trading where it is at all?
According to the sources, the only reason it's got any pulse right now is new games and toys coming out. That's basically it.
But the real fascination in the sources, it seems, is this GameStop connection to Bitcoin. GME is jumping into the Bitcoin game.
Yes. And the view on buying GameStop to get Bitcoin exposure, it makes less than 0 cents.
Less than 0 cents. Pretty clear. And this connects to something else they talked about, this MicroStrategy copycats thing.
Correct. The sources point to 3 main companies trying this playbook, sort of. MicroStrategy itself, GameStop, and DJT. And GameStop and DJT are explicitly called probably 2 of the least ethical companies in the world. Basically just copying MicroStrategy. And even MicroStrategy's model gets questioned by one source here, maybe hinting it's like a Ponzi scheme.
Right. And the financing strategy they highlight for GME and DJT is, it's really unusual. astonishing even to the sources.
It really is. DJT apparently raised $1 billion, GameStop $1.3 billion, using convertible notes, right? Debt that can turn into stock, but without paying any interest. And here's the kicker. Without a stated conversion rate, it's just down as to be determined.
Wait, zero interest converts with no set conversion price yet. I can see why the sources are stunned. They question how institutions could even provide money on those terms. Like, what about fiduciary duty if Bitcoin tanks?
Absolutely. They're asking, how could you possibly justify that investment, especially if Bitcoin drops hard? It just flies in the face of normal finance.
And they contrast this with, say, smaller companies maybe buying some Bitcoin with their own treasury cash. That's seen as a bit more understandable, though still maybe not what shareholders want.
Yeah, exactly. If a company has extra cash, maybe sitting on treasury stock, and decides, okay, let's buy some Bitcoin instead of our own shares. You can kind of see the logic. The argument is maybe Bitcoin has more volatility, more asymmetric upside potential than their own stock. You might not like it as a shareholder, but you can understand the thought process. The big red flag here is raising new money, especially on these bizarre terms, specifically just to buy Bitcoin.
So why is this deep dive into GME and DJT important for you listening? Well, it paints a vivid picture of the speculative fever and, frankly, weird financing structures popping up in certain market corners right now, especially around things like corporate Bitcoin buys. It highlights risks and behaviors way outside the norm.
It really does. Shows you the extreme speculation can reach sometimes.
Okay, moving on to the other earnings this week. Oracle and Adobe.
Right. Oracle's described as a tough stock to trade around earnings, though it's apparently more liquid than Adobe or GameStop this week. Oracle used to be like one of the busiest stocks way back, .com peak maybe. Things have changed. The options market is pricing in about a $13 move for Oracle this week. One source thinks that's kind of low personally, given its history. Adobe, meanwhile, is just described as expensive and with wide-thin markets.
Wide-thin markets. What does that practically mean for trading it?
It just means there's a bigger gap between the buy price and the sell price, the bid and the ask, and not a lot of shares available right at those prices. So it can be harder, maybe more costly to get your trades filled, especially if you're trying to trade any decent size.
Right, less smooth. Got it. And thinking back, last week's earnings, Lulu, DocuSign, they both moved way more than expected, right?
That's right. Lulu dropped a lot, maybe 60, 70 points,
Yeah.
which was like double the expected move priced by options. DocuSign was also way outside its range. The sources note this can happen late in the earnings cycle, maybe fewer eyes on them. Plus, frankly, these weren't seen as great trading vehicles by these sources anyway.
Okay, let's swing back to the macro view now, the bond market. It saw a nasty reversal last week, according to the sources.
Yes, quite a turnaround there. And adding a political layer, the sources mention chatter about the president yelling at Jerome Powell to cut rates over the weekend.
And the interpretation of that kind of pressure?
The sources read is that this public nudging probably means the Fed won't cut anytime soon. You know, they don't want to look like they're bowing to political demands.
Okay. So how does the upcoming CPI data fit in then?
Well, the CPI numbers coming up, they might actually show things cooling down a bit on the inflation front, which, on paper, supports cuts. But the feeling is the Fed won't exactly rush to the rescue with cuts soon, partly because of that political backdrop. Meanwhile, you've got the fiscal side government spending, Congress doing whatever it is that they're doing, kind of implies less coordination maybe.
The sources also drew a line connecting the moves in the long bond, like Treasury futures and stocks, saying it was basically the same move, starting around, May 22nd?
Yeah, that date was flagged as a key point. Around then, the S&P started its recent climb, and long bonds started lifting off their lows too. The analysis is that the market knows it wants cuts. You can't see it in things like break-even rates, what the bond market implies about future inflation. And the sources think the main story is shifting. It's not just runaway inflation because of tariffs anymore. It's more like the tariffs themselves could cause an economic slowdown.
So if cuts aren't expected right away, why is the long end of the bond market getting bid up? Prices rising, yields falling.
The market's betting that, okay, cuts might come later than we hoped, but when they do, there'll have to be more of them. It anticipates the Fed eventually having to catch up, maybe quite aggressively, if the economy really slows down.
And this view leads to a clear strategic preference in the sources, liking long bonds more than I like being short stocks.
Explicitly stated, yeah. And the trading tactic that's worked for bonds this year, just buying the dips, selling the rallies.
Yeah.
But they note you can't just buy and hold forever because there's a pretty big cost to carry.
Cost to carry. What exactly does that mean for a bond position like this?
It's basically the net cost or income of holding something over time. For bond futures, it relates to the difference between the futures price and the actual bond yield, plus any financing costs. If yields are generally rising or the curve is shaped a certain way, holding a long bond future can cost you money each day, which eats into profits if the price doesn't move your way fast enough.
Okay, so you need the price move to make up for that cost. But even though they like long bonds strategically, one source trades stocks way more often. Why?
Because being long bonds is kind of a one-trick pony. How many ways can you really play it? Buy futures, buy notes, maybe sell some puts, equities. There's just vastly more variety. Different sectors, growth versus value, individual stock stories, option strategies. It leads to trading stocks like 20-to-1 over bonds, just in terms of sheer frequency.
Makes sense. And for actually trading the bonds, they have preferred tools.
Yes, definitely. Strong preference for bond futures. Like ZN, that's a 10-year Treasury future. We're using the TLT ETF. ZN is described as what you see is what you get. Futures markets are usually super liquid. Tight markets, meaning a tiny gap between buy and sell prices. You often only give a one tick, the smallest price move, to get filled instantly, TLT the ETF. You got to do a little price discovery, you got to fight more, wider spreads, might have to wait or accept a slightly worse price, and leverage things like TBT, which goes up when bonds go down. Advised against. Too much leverage and drag.
Leverage and drag. Briefly, what's the issue there?
Leveraged ETFs use borrowing and derivatives to magnify returns, right? But that also magnifies losses. And over time, especially if the market chops around, they tend to decay in value. That's the drag. They often don't track the underlying thing perfectly long term. They're complex.
Okay, so why is this whole bond and macro discussion important for you listening? It really shows how these big picture factors, even politics, are seen to ripple through different assets. It explains why sources might make certain strategic calls, like preferring bonds over stocks right now. And crucially, it shows why the instrument you choose to trade matters a lot for your actual results.
Yeah, it's all connected. And how you play it matters.
All right, let's dive into commodities, starting with crude oil. Noted crossing 64. Volatility's down, IVR around 32, but options volume is still higher than the futures volume itself.
Correct. Yeah, IVR, implied volatility rank. 32 means current implied vol is pretty low compared to where it's been over the last year or so. Lower third, basically.
Got it. Thanks. And the sources have like totally different ways they're approaching oil right now.
Yeah, quite diverse. One source got out of shorts, felt the risk reward was better, shorting higher up, took a small loss on the way down. They're not long yet, waiting for a clearer break above old resistance. And, their bias is maybe away from cyclicals like oil if the economy cools, but they'll trade the price action if it says otherwise.
Okay. Then another source has a totally different angle, basically because they have no opinion on where oil's going next.
Exactly. So what do? They sell premium. They're running a delta-neutral strangle. Currently short the July 61 puts and the July 66 calls.
Okay, hold on. Selling premium, delta-neutral strangle. Break that down for us.
Sure. Selling premium just means selling options to collect the cash up front, hoping they expire worthless or lose value. A strangle is selling both a put below the current price and a call above it. Delta neutral means they try to set it up so it doesn't immediately gain or lose much if the price wiggles slightly up or down. It profits mostly if the price stays between those 61 and 66 strikes and if volatility goes down. And they like this trade because vol was much higher, maybe 55, 57 IV rank a few weeks back, and now it's down at 32. So they collected richer premium.
Interesting. Profiting from it not moving much and vol dropping. And then there's a third approach, more defined risk.
Yep. That source is in a short iron condor. Strikes are 53.55 on the put side, 68.70 on the call side, about 39 days left. An iron condor is like a strangle, but you also buy further out options for protection, limiting your max loss. Also profits from price staying in the range and vol falling. Their plan is, if oil moves above 64, they'll likely recenter the whole structure higher, move the strikes up to keep the current price in the middle, which they note is a bit harder to adjust than a simple strangle.
Okay, so why lay out all these different oil trades?
It just shows you how traders can look at the same market, crude oil, and come at it from completely different angles. Some have a directional view based on price, some have no view, and trade volatility instead. Some use defined risk structures managed by price levels. It highlights the different tools and mindsets.
Right. Let's move to metals. Silver had a big week, tied to gold's move too.
Yeah, the gold-silver ratio, just price of gold divided by price of silver, is around 92 now. There was a mention of a past pairs trade on this ratio, buying one, selling the other, based on it reverting to the mean. They got in when the ratio was really high, over 92, even over 102 at one point. Held it a long time, but it worked out eventually. They got out just under 95, now back in 92. That source sees it as kind of fair value.
And current positions in metals. Pretty split, right?
Very split. One source,
Yeah.
flat silver, but short gold. Describes gold as actually one of the best shorts on their board right now. They just like the pot odds of being short here.
Pot odds. Like poker again. Meaning the risk versus reward looks good for a short.
Exactly. Not necessarily needing a huge, complex macro reason why gold must go down. More like, at this price level, the setup looks favorable for a short trade from a risk-reward standpoint. But the other source, totally opposite. They're long gold.
And their reason for being long gold is tied back to that bigger macro picture we talked about.
Yes, exactly. The source who's long gold connects it all together. They think long bonds are going higher. They think the dollar looks vulnerable. They think stocks are more of a sell than a buy right now. They see the market anticipating a slowdown where the Fed eventually has to play catch-up with rate cuts. And in that world, gold potentially getting back towards, say, 3,300, 3,500, it's all part of one idea for them, linked to the bond and stock view.
Wow. Fascinating how you get two completely opposite trades on gold from different analyses. What about other metals, silver, copper?
One source specifically said they have no exposure there. Why? Lack of a good instrument to trade them. Futures contracts are maybe too big for their desired position size. And the ETFs.
Not liquid enough for their style.
Not liquid enough. Same issue as Adobe, pretty much. Not enough trading volume, wider spreads, harder to get in and out cleanly and efficiently.
Okay. So why does this metals discussion matter for you?
Well, it really drives on how different traders can have opposite views on the same asset, like gold, based on totally different logic. Simple pot odds versus a complex macro story. And it also shows how practical things like whether a good trading instrument even exists and is liquid enough, heavily influence what markets pros actually trade.
Yeah, there's no one right view. And execution, including the instrument, is key.
All right, let's wrap this up. What's the overall outlook, the trading stance heading into this week, based on these sources?
The general feeling is described as a little short the market, but I'm not bearish.
That's an interesting way to put it. Explain that difference. A little short, but not bearish. It means, based on how things look right now, the pot odds favor the downside, meaning if the market does go down, they're positioned to potentially profit. But it's not a strong conviction call that it must collapse from here. If it keeps grinding higher, could be a little bit of torture for those short positions. It's more about positioning for what seems like a better risk-reward, not a certainty.
And it's noted that when vol is this low and there aren't obvious big earnings plays jumping out, it's just harder to find good trades.
Yes, exactly. Low vol can make it tempting to force things. Take trades that aren't really A-plus setups just because you feel you should be doing something. The advice is don't. Those earnings this week, Oracle, Adobe, GameStop, are examples given. If this setup for that specific stock isn't compelling on its own, it's never worth the force.
Are there specific stocks flagged as looking maybe a bit frothy, interesting for shorts?
Yeah, Meta around $700 gets mentioned, partly just because it hasn't had a down tick forever, feels extended. Microsoft around $407 is also highlighted as potentially interesting on the short side.
But Apple is different this week.
Yeah, specifically because of the developers conference. One source is actually leaning a little long Apple into that. Says they wouldn't short it right before the event, even if they expect the conference itself might disappoint. It's a short-term, event-driven tactic overriding a perhaps different underlying view. So putting it all together, the consolidated positions mentioned kind of reflect this overall stance. Short Meta, short Microsoft, short premium in Tesla and NVDA.
Which probably means selling calls or call spreads against them, right? Betting they stay capped.
Presumably, yeah. Then also long bonds, short stocks overall, maybe via index futures or ETFs, and short gold.
And the general approach fits that low vol environment.
Yeah, generally underweight. Sitting on a lot of dry powder is the phrase used, meaning holding a good amount of cash, ready to deploy, waiting for better opportunities rather than forcing trades when things are quiet.
And the big prediction for the market overall right now?
That we're probably in a really good range-bound market for a while right now, expecting more sideways chop within a range.
So how should you process all this? Well, it gives you a real insight into how traders think about risk, opportunity, and importantly, patience. Especially when volatility is low, it flags specific areas they're watching or trading, that relative value between bonds and stocks, selling premium, looking for potentially overextended names.
It's about marrying that big macro picture with the specific tactical plays on the ground.
Right. And as we finish this deep dive, here's something to think about. The sources suggest the broad market is trying to look years ahead, normalize, find a stable range, kind of ignoring the immediate political noise.
Yeah.
Okay. Yet in pockets of that same market, you see companies using these incredibly strange, unprecedented financing methods, zero-interest converts with no price, tied to really speculative assets like Bitcoin, stuff that seems to defy normal finance.
Yeah, it's like two completely different markets existing at the same time.
So what does that tension between the market trying to be rational and forward-looking and these pockets of maybe extreme speculation tell you about where we are right now? It's definitely something worth mulling over as you watch things this week.
Absolutely. A real market of contrast right now.
Well, thank you for joining us for this deep dive into your sources. We'll definitely check in again soon.
Sounds good. Yeah, lots to keep an eye on.